commercial banks reduced their short position by almost 16,000 contracts in gold at 100 ounces apiece, almost 6,000 contracts covered in silver. They drove down the price. The hedge funds all sold, locked in their profits, and it kept triggering sell stops. More selling begets more selling begets more selling. That's exactly what they wanted. That's the realization. Gold and silver went on sale as a result of this drubbing, if you will. And the fact that it hasn't changed the fundamentals is something I think that's not lost on the big traders. And you're seeing them accumulate more and more and more, challenging these short positions. And this is something that I don't expect to stop.
The recent volatility in the gold and silver markets has been significantly influenced by economic pressures, geopolitical uncertainty, and the substantial short positions held by commercial banks. These short positions, particularly in silver futures markets, have played a critical role in distorting prices, preventing these precious metals from reaching their true market value. Estimates suggest commercial banks have shorted between 750 million and 800 million ounces of silver, equivalent to a year's global silver production. This scale of aggressive short selling has resulted in a market environment where paper contracts dictate prices rather than the underlying physical supply and demand. One of the most concerning aspects of price suppression in the silver market is the growing discrepancy between futures market prices and the actual value of physical silver. As market expert Andy Schectman points out, physical silver and gold prices should dictate the direction of futures prices in a properly functioning market. However, the current market dynamics have shifted, with a small group of large commercial banks holding speculative paper positions that manipulate the price discovery process. This manipulation has led to significant distortions, particularly in the silver market, where demand from critical sectors such as electric vehicles and renewable energy continues to surge. Despite this growing demand, oversaturated short positions have kept silver prices artificially low. Many experts believe that this situation is unsustainable, and that once these short positions are unwound, the silver market could see a significant price increase as the true value of the metal is more closely aligned with its physical demand. Another critical element exacerbating these market dynamics is the growing global demand for physical precious metals, particularly from countries like China and Russia. Both countries have aggressively increased their reserves to hedge against economic instability and the devaluation of fiat currencies. This shift towards tangible assets puts pressure on the markets, revealing the vulnerabilities of commercial banks' short positions. As demand for physical metals rises, banks may be forced to cover their shorts, potentially triggering sharp price increases in both gold and silver. As we bring you clips from the discussion, please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this.
In general, what's been on my mind is the price drop in gold and silver and people's overreaction to it. I think it was just that, an overreaction. You have massive short positions on both COMEX and the LBMA by the commercial banks, who have been getting blistered by the continual rise in the price of gold, really, and silver, really engineered by the countries in the global south who have been accumulating gold and silver hand over fist, amongst other commodities too, rare earths and base metals and even soft commodities. But we're seeing a drive to accumulate real things, which is a very dangerous position to be in for a commercial bank who's naked short. On COMEX, in the case of the silver market, short between 750 and 800 million ounces, about a whole year's worth of global mine production. In London, many times that, between 4 and 6 billion ounces short, naked short, paper short, for whatever reason. We've talked a lot about that, the military-industrial complex and the need for silver. Those numbers are irrefutable, yet not calculated in the Silver Institute supply-demand number. Another 260 or so million ounce shortfall between supply and demand for mine supply this year, according to the Silver Institute. And yet you have 8 Western banks shorting the prices the way that they have been. And I think what it really was, this decline. And first of all, let's say the decline was in silver futures. Let's just focus on silver for a moment, and gold futures. But because really it's the futures market, the tail wagging the dog, that controls the price. It should be the other way around. It should be the commodity controls the futures, not the paper futures controlling the commodities. And it's kind of backwards. At least it's mitigated, or it's migrated to that phenomenon, one that may not last forever. In fact, it shouldn't be this way, but it is. And when you have very, very well-heeled banks who have the ability to create a reality through paper contracts, either long or short, it creates some distortions. And those distortions were very real. And I think this big decline in the futures over the past couple weeks was a result of, or a belief, and I think the traders believe that that the people believe that the Trump administration was going to halt the upward trajectory of the irresponsible fiscal policy and the massive spending, federal spending addiction that we have. Bringing out Vivek and Elon to trim the fat, and of course, choosing Bitcoin over gold and silver as the next key component to the sovereign reserves. All of which I think is irrational, but they used that irrational exuberance to push the ball down the hill. And what we saw, and that being the shorting, they shorted the price just to get it going in that environment.
As President Donald Trump embarks on his second term, the United States faces an unprecedented debt crisis, with the national debt reaching a staggering $36 trillion. This alarming figure continues to grow unsustainable, and experts predict that the debt-to-GDP ratio could soon exceed 200%, signaling severe economic strain. The rapid accumulation of debt, from $5.7 trillion at the beginning of the 21st century to $23.2 trillion by 2020, has been exacerbated by the COVID-19 pandemic, which added $16 trillion in just a few years. In recent months, the debt has been increasing by $6.3 billion daily, meaning each American is responsible for roughly $108,000 in national debt. As the U.S. faces a historic debt crisis, Andy stresses the growing significance of investing in hard assets like gold and silver. With the rising national debt at an alarming rate and inflation putting pressure on the dollar's value, these tangible assets are a reliable hedge against financial instability. Andy points out that gold and silver offer a more stable store of value than speculative investments like cryptocurrencies.
Bottom line is our government has the biggest debt, or is the biggest debtor in the history of the world, and it's yes, continuing to grow at a rapid pace, and it's an unstoppable pace. You can bring in Vivek and Elon and tell them to trim the fat. The truth of it is that you first have to address the government spending, not just the waste in their bloated beast that they are. The last two payrolls, I think you have or employment numbers, I think you have pretty damn close to 800,000 government employees hired over the last two unemployment readings. I mean, that's just ridiculous. Private sector jobs are being shed. You have to address government spending first and foremost, and efforts to reduce spending will be meaningless unless there's the political will, which, ain't easy, to make the cuts in things like entitlements, welfare payments, national defense, veteran benefits, Medicare, Social Security. I mean, come on, you think they're going to do that? They've already said they won't. And if they don't do those things, then forget about, even if you had a balanced budget today, you have the massive amount of debt that we've already accumulated. The Congressional Budget Office says that by 2031, 100% of tax revenue goes just to pay the interest on the debt and mandatory entitlement spending like Medicare and Social Security. And so while the government should be able to, I would argue, keep this charade going longer than any other entity on the planet, because we have the printing press, just about all the empires going back throughout history, um, start to struggle or struggle or start to break when they struggle to pay their interest costs. And that's where we're at right now. A moment of reckoning is on the horizon that would have huge implications based upon the fact that, think about military spending, it's discretional. So if the Congressional Budget Office is right, they're nonpartisan, and that it really is the case, how can we pretend to be the world's dominant superpower when 100% of military spending would have to be borrowed? You can't be this massive power when, you know, you're printing money to buy your own debt to keep the ball moving, and it becomes a problem. Look, when companies go bankrupt, it's the shareholders that get their ass handed to them. But when governments go bankrupt, if you're holding the overpreponderance of your wealth in dollars, you will go broke. That's the important thing to understand, is that it's hard to believe that the US government would ever go broke, right? But I mean, if this were your home, this was your personal finances, well, you are broke. You have a $36 trillion debt. If you look at the United States government entity itself, it's got a 36, almost $37 trillion debt. So we're broke, we're insolvent, damn near, we're well near 130% debt to GDP, a few percent away from that. There's never been a country that's come back from that in history without either hyperinflating or defaulting. So yeah, these are very challenging times for sure. And I guess I would just simply say anyone that would hold a 10-year treasury has to have their head examined.
The silver market is expected to experience significant shifts as the ongoing manipulation in future markets becomes increasingly unsustainable. The growing demand for physical silver, driven by its critical role in industries such as renewable energy, electronics, and electric vehicles, is likely to put upward pressure on prices. Despite the historical suppression of silver prices through paper trading, the gap between paper silver and actual physical supply is widening. As more investors and industries recognize the growing scarcity of silver, its true value may be revealed, leading to a price correction. While short-term fluctuations are inevitable, the long-term outlook for silver remains positive, with expectations for substantial price appreciation as the physical market tightens and demand grows. Please share your thoughts on Andy's analysis in the comments below. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more videos like this. Thanks for watching.